Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video we are going to quickly revise the special income tax rates for assessment year 24-25. Then we will revise the special surcharge rates, and lastly we will also discuss section 115 BAC, which is the new tax regime. Okay, so firstly let's come to special tax rates. Sir, what is so special about these special tax rates? The special thing is that this tax rate is mentioned in that section itself. Because of this, whether the assessee is choosing old tax regime or new tax regime, it does not matter. The tax rate will remain the same. Okay, so these special tax rates we had already discussed in different revision lectures. Now we are discussing once again, so I am just brushing up very quickly. So firstly, there is section 115 BBE, which taxes undisclosed source of income, which is what? Unexplained money, investment, expenditure, bullion, jewelry, etc., under section 68 to section 69D. So what is the tax rate? The tax rate is 60% plus 25% surcharge plus 4% health and education cess. Next tax rate is under section 115 JC, which talks about alternate minimum tax, that is AMT. First and foremost, AMT is only applicable to old tax regime and not applicable to new tax regime. You should also remember that if there is new tax regime under section 115 BAC, which is the default tax regime now, then old AMT credit also will lapse. Okay, so what is the AMT rate, Kanna? AMT rate is 18.5%. In case of cooperative society, it is 15%, and in case of International Financial Service Center IFSC, it is 9%. Then let's come to capital gain. In capital gain, first section is section 111A. 111A deals with short-term capital gain. Short-term capital gain in case of transfer of equity shares in a company, equity-oriented fund, and business trust. There are some other conditions also which we had discussed with that section. So what is the tax rate? The tax rate is 15%. Then section 112A. Similarly, there is for long-term capital gain on transfer of equity shares in a company, equity oriented fund, and business trust. The tax rate is how much? 10%. However, it is 10% above 1 lakh rupees. So on the first 1 lakh rupees there will not be any tax. Above 1 lakh rupees there will be taxed at 10% only under section 112. So all the other remaining long term capital gain is covered under section 112, which tells that the tax rate is 20%. So 112A is 10% above 1 lakh rupees and 112 is 20% for general long term capital gain. Then we discuss section 115 BB, which discusses winnings from lottery, crossword puzzle, races including racehorse, card games of any other sort, betting and gambling. For this, the tax rate is how much, Kanna? It is 30%. Okay, and there is a new section, that is 115 BBJ, that is net winnings from online games. In this case also the tax rate is 30%. Now when it comes to section 115 BBE, 115 BB and 115 BBJ, you have to be very careful since these are some negative type of taxes. That is why no basic exemption limit is allowed for the individual or HUF. Then no loss is allowed to be set off, no deduction is allowed, and the loss is also not allowed to be carried forward. So these you have to be very careful. Next, let's talk about buyback. Firstly, what is the tax rate on how to calculate the value of income? It is tax on buyback price minus issue price. So the income is what? Buyback price minus issue price. And what is the tax rate? It is 20% tax plus 12% surcharge plus 4% health and education cess. So this covers all the special tax rates. Now let us discuss the special surcharge rates. Sir, what is this special surcharge rate? Special surcharge rate means for certain incomes like dividend, 111A, 112 and 112A, the surcharge is capped at 15% only. The surcharge cannot go more than 15% for these types of income. So how you are going to calculate the surcharge, Kanna? Firstly, see if the total income is more than 2 crores or not. If the total income is not more than 2 crores, you need not see this section at all. You calculate normally. Okay, the surcharge you calculate normally. But if the total income is more than 2 crores, then you have to divide the total income into two parts, Kanna. What are the two parts? The first part is dividend, 111A, 112 and 112A income. That is first part. And second part is income other than dividend, 111A, 112 and 112A. Now, see the income which is other than dividend, 111A, 112 and 112A. If it is up to 2 crores, then on the entire income, the surcharge will be 15%. Now, if the income other than dividend, 111A, 112 and 112A is more than 2 crores, but up to 5 crores, then on the normal income, the surcharge is 25%, but on the dividend, 111A, 112 and 112A income, the surcharge will be 15%. Similarly, if the income other than dividend, 111A, 112 and 112A is greater than 5 crores, then on normal income, the surcharge will be 37% in case of old tax regime, 25% in case of new tax regime. Okay, 37% in case of old tax regime, 25% in case of new tax regime. And in case of dividend, 111A, 112 and 112A income, it will be how much? 15%. Here you can keep it 37/25. 37 in case of old regime and 25 in case of new regime, that is 115 BAC. Fine. So this is done. Now you might all get a query that in case of dividend income, it is very difficult to segregate because dividend income is also taxed at normal tax rate. So in such case, for dividend alone, you have to find out proportionate surcharge. How to calculate proportionate surcharge? I have given you an example. Now in revision lecture, I am not going to be discussing that. So you can take you can pause the video and you can take a screenshot of this page to understand the example if you want. Fine. Now let me come to the very important part, that is section 115 BAC. So Kanna, for every taxpayer, there are two tax regimes, the old tax regime and the new tax regime. Old tax regime is only the normal provisions or the normal tax rates. This normal tax rate only I had discussed in the first revision lecture. Now in this revision lecture, I am going to discuss the new tax regime. And now this new tax regime is very important because this new tax regime has become the default tax regime. Karna. Default tax regime. And what is the section that deals with new tax regime? It is section 115 BAC. Section 115 BAC. So now the new tax regime is the default tax regime and old tax regime has become the optional tax regime. New tax regime is default and old tax regime is optional. Okay, so now let us study what is given in the new tax regime. What is the major difference between old regime and new regime? In old regime, the tax rates are high, but the exemption and deduction is also high. But in the new tax regime or default tax regime, the tax rate is a little bit low, but certain exemptions and deductions are not allowed in the default tax regime. So now let us discuss what are all the tax rates in the default tax regime and what are all the exemptions and deductions that are not allowed in the default tax regime. So firstly, for whom and all this default tax regime is applicable? It is applicable to individual, HUF, AOP, other than cooperative society, BOI and AJP. So individual, HUF, AOP, BOI and AJP, whether they are resident or non-resident, default tax regime is applicable to them. Okay. However, to cooperative society is not applicable, Karna, because for them there is a separate tax regime. Okay. Now, is this default tax regime applicable on special rate of income? Answer is no. It is only applicable on the incomes that is other than special rate of income. So what and all we discussed before, that is 111A, 112A, etc., that will all remain the same as it is. It will not change. So for all the normal incomes, what is the tax rate? Up to 3 lakh rupees, no tax. Up to 3 lakh rupees, no tax. And here be very careful. Here there is no senior citizen, super senior citizen concept. Okay. So for everyone up to 3 lakh rupees, no tax. Above 3 lakh rupees, up to 6 lakh rupees, 5%. Above 6 lakhs, up to 9 lakhs, 10%. Above 9 lakhs, up to 12 lakhs, 15%. Above 12 lakhs, up to 15 lakhs, 20%. And above 15 lakhs, 30% tax. Now be very careful, there is no 25%. After 20 there is directly 30% tax, so that you have to be very careful. So this is the tax rates. Sir, what about surcharge? Surcharge is same karna in the old tax regime as well as new tax regime. Surcharge is same. However, the 37% surcharge is not applicable to the default tax regime. So maximum surcharge is how much? 25%. So if the total income is above 2 crores, the surcharge will be 25%. Okay, now let us quickly see what are all the deductions and exemptions that are allowed in the old tax regime but not allowed in the default tax regime. Okay, so first is section 10 clause 5, that is leave travel concession, which we studied in salary chapter. Then section 10(13)(a), house rent allowance, also not allowed. Then section 10 clause 14, the special allowances that are given in section 10 clause 14 are not allowed, but 4 allowances are there which are allowed as exemption in both old tax regime as well as new tax regime. What are those 4? Transport allowance, conveyance allowance, travel allowance and daily allowance. Come on, say once again. Transport allowance, conveyance allowance, travel allowance and daily allowance. These 4 allowances are allowed as exemption both in old tax as well as new tax. Okay, so there is no change. Next, section 10 clause 17, daily allowance given to or constituency allowance given to MP or MLA. So this is not allowed in the default tax regime. Then section 10(32), minor exemption also not applicable in the default tax regime. Then section 10 clause AA, the exemption for or deduction for special economic zone not applicable for default tax regime. Then in section 16, that is salary chapter, there are 3 deductions, correct? Standard deduction, entertainment allowance and professional tax. So entertainment allowance is not allowed in default tax. Professional tax also not allowed in default tax regime, that is section 115 BAC. But standard deduction, that is 50,000 rupees, it is allowed in both old tax as well as new tax. Okay, so this is a change, be very careful. Now let's come to house property. Section 24B, interest on housing loan is not allowed as deduction in respect of self-occupied property in case of 115 BAC. So in the new tax regime, for self-occupied property alone, interest on housing loan is not allowed. Sir, what about let out property? For let out property, interest on loan will be allowed as deduction in both old tax as well as new tax. That there is no change. Next, section 32(1), additional depreciation also not allowed under new tax regime. Now let's come to scientific expenditure. Scientific expenditure also, deduction in respect of in-house research is allowed as deduction in both old tax as well as new tax. However, contribution is allowed only in old tax, not allowed in section 115 BAC. Let me tell you once again, all the contributions are not allowed in section 115 BAC. But what about in-house research? In-house research is allowed in 115 BAC also, it is allowed in old tax also. Now let's come to section 35 AD. Section 35 AD, that is specified business, this deduction also not allowed in new tax regime. Also, if there is any loss related to section 35 AD, you cannot carry forward under the new tax regime. That also you have to be very careful. Then in income from other sources nokanna, there was a family pension deduction. Earlier it was not allowed, but now that also is allowed as deduction. So they are making this new tax regime more and more lenient and friendly for the assessee. So family pension deduction is allowed under both old tax as well as new tax. Next, what about chapter 6A deduction? Chapter 6A deductions are not allowed under new tax regime. Under 115 BAC, chapter 6A deductions are not allowed. However, certain chapter 6A deductions are allowed. What are they? They are contribution to NPS under section 80 CCD subsection 2, that is employer contribution. Then Agniveer Corpus Fund under section 80 CCH subsection 2, and lastly the 80 JJAA for new employees, there is deduction, no? That is also allowed. So 3 deductions are allowed: 80 CCD subsection 2, 80 CCH subsection 2, and then 80 JJAA. These 3 deductions are allowed in both old tax as well as new tax. all the other deductions 80C, 80D, 80U, 80G, etc., all those are only allowed in the old tax, not allowed in the new tax. Fine. Now let us talk about set off and carry forward of losses. In set off and carry forward of losses kanna, when it comes to the house property head of income, you cannot do interhead adjustment under the new tax regime. In old tax regime, you were able to do interhead adjustment up to 2 lakh rupees, but in new tax regime, you cannot do any interhead adjustment. Okay. And what about additional depreciation? Additional depreciation is not allowed in what about additional depreciation? Listen here, Kanna, if there is any unabsorbed depreciation, okay, this unabsorbed depreciation can contain both normal depreciation as well as additional depreciation. I already told you that normal depreciation is allowed in both old tax as well as new tax, but additional depreciation is not allowed under section 115 BAC. So what about the loss that is because of additional depreciation? This additional depreciation loss also cannot be carried forward. But this is a depreciation, correct? This additional depreciation would have resulted from reducing the cost of capital asset, correct? Only if there is a capital asset, okay, there is a WDV. From this, you would have reduced the additional depreciation, and after that only this additional depreciation is a part of unabsorbed depreciation. Unabsorbed depreciation, correct? So now, since this additional depreciation cannot be carried forward, hence you have to add back this additional depreciation in the opening WDV. So additional depreciation cannot be carried, in short, additional depreciation cannot be carried forward. Hence, whatever additional depreciation is there in the unabsorbed depreciation, that has to be added back to the opening WDV of the fixed asset. Okay, it is not that important. If you are able to grasp it, well and good. If not, don't worry, just ignore it. Next. Now let's talk about rebate. Okay, so rebate, like in the old tax regime, in the new tax regime, that is 115 BAC, also rebate is allowed. But in the old tax, rebate is allowed only up to 5 lakhs. But in new tax, the rebate is allowed up to 7 lakh rupees. Up to 7 lakh rupees. And how much amount of rebate is allowed? Answer, it is 25,000. So up to 25,000 for resident individuals having a total income of up to 7 lakh rupees. So how much is the rebate? 25,000 or actual tax, whichever is lower. 25,000 or actual tax, whichever is lower, for resident individual having a total income of up to 7 lakh rupees. And now in this rebate concept, there is marginal relief also. Hence, if the total income is up to 7,27,770, if the total income is up to 7,27,770, then you have to apply this step also. What is the step? First, you have to find out what is A. A means total income minus 7 lakhs. Then you have to find out what is B. B means income tax on total income. Then if B is greater than A, then rebate is equal to B minus A. If B is greater than A, then rebate will be how much? B minus A. This will apply only if the total income is more than 7 lakhs, but up to 7,27,770. Then you have to find out the marginal relief for rebate also. Okay. I have explained this concept in detail in the amendment lecture. So if you are not able to understand in the revision, please go back to the amendment lecture. You will be able to quickly grasp the concept. Fine. Next, additional points for section 115 BAC. The section 115 BAC has now become the default tax regime. So by default, now you have to file the return of income under section 115 BAC. That is the new tax regime. But if the assessee want to shift out of the new tax regime and go to the old tax regime, then also the assessee can do that. If the assessee does not have any PGBP income, then every year the assessee will get the option to shift out of the new tax regime. So this year, if I am in the default tax regime, I can be in the default tax. Next year, if I want to shift out, I can shift out also. After that, if I want to come back to the default tax regime, I can come back also. It will not be a problem. But what if there is PGBP income? If there is PGBP income, that is income under the head profit and gains of business or profession, the assessee will have the option to shift out of the old tax regime only once. And if they exercise the option to shift out, they cannot come back to the new tax regime. However, if they do not satisfy the conditions and come back to the default tax regime, they will never be able to shift out of the default tax regime once again. So for example, listen here. For previous year 23-24, let's say the assessee is having PGBP income. Okay. Now the default tax regime is what, Kanna? It is 115 BAC. The assessee feels that 115 BAC is not beneficial. I want to go to old tax regime. So if the assessee is going to old tax regime, he can do so, no problem. But after this, lifelong the assessee has to continue in old tax regime only. Okay, so one time they can shift out. After that, lifelong they have to be under old tax regime till they are having PGBP income. Fine. Now, sir, what happens is, let's say in previous year 26-27, now they feel that they want to come back to new tax. In such case, they can come back to new tax regime only once. And if they come back to new tax once, they will never be able to shift out once again. With this, matter is over. Okay. So if the assessee is having PGBP income, then they have an option to shift out only once. If they shift out, they have to stay in the old tax regime. But if they choose to come back to the new tax regime, they will never be able to shift out once again. So this is the provision. Now, if there is an employee wants to opt out of section 115 BAC, he can intimate his employer every previous year. Now listen carefully. Whenever there is an employer-employee relationship, there is salary income, correct? And if the salary income is more than the threshold limit, then the employer will deduct TDS. Normally, employer should ask the employee about the tax regime. If the employee is telling default tax regime, TDS should be deducted under default tax regime. If the employee is telling old tax regime, then TDS should be deducted under old tax regime. Sir, what if employee is not telling anything? In such case, employer should deduct the TDS under the default tax regime. That is the new tax regime only, employer should deduct the TDS. Fine. Now later on, let's say employer is deducting the TDS under default tax regime. But while filing the return of income, the employee wants to change the regime. Can the employee change? Answer is yes, employee can change, no problem. Okay. So these are the points. Now let us discuss some other sections quickly. Section 115BAA deals with domestic companies. So now we discussed old tax regime and new tax regime, no karna. That was for individual HUF, AOP, BOI and AJP other than cooperative societies. Now we are going to discuss the new tax regime for all the different other types of persons. But for that, only if you know the basic rates, it is enough. You need not know the entire detailed section. It is not a part of your syllabus. Fine. So for domestic companies, the new tax regime is under section 115BAA and it is only for, and what is the tax rate? The tax rate is 22% tax plus 10% surcharge plus 4% health and education cess, which is effectively 25.168%. Then there is section 115BAC, which is a special section for domestic manufacturing companies, including generation of electricity. If it is set up on or after 1/10/2019, then they can opt for a concessional tax rate of 15% tax plus 10% surcharge plus 4% health and education cess. Effectively it is coming at 17.16%. Okay, so very beneficial. Then there is a new section called section 115 BAE. This section is for resident cooperative society. For whom? Resident cooperative society. They can opt for concessional tax rate at 15% plus 10% surcharge plus 4% health and education cess. So this will also be effectively 17.16%. But this benefit will only be given if they are manufacturing and they commence the manufacturing on or after 1/4/2023. Okay, and before 31/3/2024, then they can opt for this section, that is 115 BAC. Then there is another section called 115 BAD, which is for other cooperative society. So if there is a resident cooperative society other than the above, they can opt for concessional tax rate of 22% plus 10% surcharge plus 4% health and education cess, which is effectively 25.168%. So for both domestic company as well as resident cooperative society, the provisions are similar. If they are not in manufacturing, it is 22% plus surcharge plus cess. If they are a new company or new cooperative society which are engaged in manufacturing, then it is 15% plus surcharge plus cess. Fine. Now one more last special point. If any royalty and fee for technical service is received by a foreign company from the government or Indian concern in accordance with agreement made between 1961 to 1976, that is royalty agreement. It is a very old provision which is now no more relevant, but I am just telling you in case of MCQ. Okay, and between 1/3/1964 and 31/3/1976, then the tax rate is 50%. So royalty and fee for technical services in case of these specific agreements is taxed at 50% if it is received by foreign company from the Indian government or Indian concern. Okay, so these are all the provisions. I hope now you are thorough with all the provisions and you will be able to rock in the examinations. நல்லா படிங்க, எக்ஸாமில் செஞ்சிருங்க, எக்ஸாமுக்கு அப்புறம் எனக்கு மெசேஜ் பண்ணுங்கள். ஓகே, விஷ் யூ ஆல் த பெஸ்ட் ஆஃப் லக். டேக் கேர். பை பை.